Hello, welcome once again for the third video of microeconomics. In the previous, we have discussed different issues on our video 2, and now I am Balaizode and I am excited to guide you through another enriching session in microeconomics, a subject that plays a vital role in understanding national and global economic dynamics. I hold an MSc in Developmental Economics and a MSc Accounting and Finance. My area is a business area, and also currently I am pursuing an MSc in Financial Engineering as well as a Master of Project Management at the respective universities. Professionally, I have served in various academic institutions such as National College and Rift Valley University, including others, as part-time lecturer. Additionally, I have extensive practical experience from my work at Central Bank of Ethiopia, where I have contributed to departments including Internal Audit and Risk Management departments, Insurance Supervision Directorates, currently serving as senior researcher in Central Bank. With this strong bleed of academic knowledges and hands-on professional experience, I'm passionate about helping you master macroeconomics as well as related fields like research methodology on other of my video and other key economic subjects. Whether you are a student at the undergraduate or postgraduate level or professionally seeking deeper understanding, this course is designed for you. So go with me. Today, from the previous number 6, that is gross domestic product. So we have seen different components in the previous. Now we see the 6, the other components, that is gross domestic products or GDP. GDP is the total market value of all final goods and services produced within a country in a given period of time. We have different words here. We have said that is final goods. That means we have to use with final good to measure GDP. Intermediate good is not included here. We'll see the reason. And it is within a period of time with bounded country or with domestically bounded products. This means the external product is not included. It also the total expenditure on all final goods and the service produced within a country in a given period of time. Again, it also the total income earned from all productive activities in domestic economy. This means GDP is measured in 3 ways, that is expenditure approach, income approach, and also production approach. Whatever the case, the value of the 3 approaches is the same. We can use either of those approach. How they are equal. One person or one country calculates GDP using expenditure approach, and the other use income approach. The other country may use the production approach, but the value is the same. Let we take example. If one party in the country is seller of the products, he gets, or that party or that team gets income. In opposite side, those who are purchasers expend or purchase by paying money, that is expenditure for them. So the value of products, the side of expenditure or in the side of income is the same. What you incur as expenditure to purchase that product is 100,000, and in the opposite side, a person who sells his products gets 100,000. The value of that product is the same. Because of this, those three approaches are the same. And also we'll see in the future clearly. Now it is a measure of a country's total income. GDP, that is total income, because we calculate per capita income, GDP per population. That's to know what amounts can each individual of the country earn. That's why it is country's total income. When judging whether an economy is doing well or poorly, it is naturally to look at the total income that everyone in the economy is earning in the form of per capita income. There are other measures of total income, but GDP is the most popular measure on the world. Final goods are those goods sold to their final users. That's why we include in calculating of GDP. And those will disappear in the process of the production of some other for sale goods. And those will be disappear, those final goods. However, goods that doesn't disappear in the process of the production of some other for sale goods are called intermediate goods, which is not included in calculating of GDP. What happens if we include intermediate goods? Let we see. The market value of intermediate good is counted when the market value of final good is counted. That's already counted. So in counting them separately in GDP, we'll be counting them twice. So we face for double counting if we include intermediate goods. So we cannot include intermediate goods like that of what we include as final goods. So counting them makes double counting of our GDP. So it is very overstated if we use such intermediate good for calculating of GDP. So we have to exclude it. How can we measure a nation's productive activity so that the numbers can be compared across a time? We have two types of GDP. Nominal GDP, which is called as GDP at current price, and also real GDP, also called as GDP at constant price. Nominal GDP is the total market value or final goods and the service produced within a country in a given period of time. We calculate nominal GDP based on the current value of the products. The nominal GDP market value is calculated using a current price, the price that prevailed when the production took place. That is current market price times that of the current goods. Real GDP value is calculated using the constant price, which are the price that prevailed in the benchmark, which is called as base year. Let we see what is base year and how we can select base years. Base year is constant years that we select for calculating of real GDP to separate or to know the actual volume of output or actual production. Every time or every year we have to know our actual production in opposite of nominal GDP, because if we calculate by using a current market value, we cannot know our production's volume. Whether our volume is increased or not, we don't know by using the current market price. Why? Nominal GDP may be increased because of price and also because of production increase or productivities because of these two, but we don't know whether it is because of our volume of production is increased, or for example our quintal of maize increased, or the price of the quintal is increased. Because of this we have to have another uh, measurement that's known as real GDP. Then to calculate a real GDP we have to have benchmark or constant price. That time or that year is known as base year. What is base year then? And how can we select a base year? Base year is a specific year chosen as point of comparison for measuring real economic activity across different years. But how base year is selected? How we select one year is base year, the other year is not base year. Ways of collecting base year is based on the following criteria. The first one is stable economic condition. The year we are going to select as base year should be a stable economic condition year. That means no time of recession or no time of boom of economy, no time for war or no time of pandemic disease, for example, such as COVID time. It cannot be a base year for us because base year should be a stable economy. The other base year should be recent and relevant. This is, it should show or reflect the current structure of the economy. Example, new industry, technology, or consumption pattern should be shown at this time. The other, availability of reliable data, means complete and accurate economic data such as production, price, and the like. This is how we can select a base year, and then by using of that base year as benchmark or constant price, we can calculate our real GDP. Nominal values, an economic statistic measured using current market price. That is the nominal value using of the current market price, not adjusted for inflation, in contrast with real value. So nominal GDP is calculated by current market price times quantity. Real value, an economic statistic measured after it has been adjusted for inflation or price. That means it is calculated by the base year, not by current year, in contrast with nominal value. It shows actual volume or quantity or productions, the actual production. For example, we take a quintals of maize. To know whether our quintals of maize is increased or not increased, we have to use a real value. We have to calculate by the base year price, not by current year price. If we calculate by current year price, and if price of the quintal increased, we can say wrongly our productivities or our quintal of maize is increased in this year. But in reality, it is not the quintal increasement. Rather, it is the increments or the increasement of price, or it is because of inflation that we get high GDP. High nominal GDP, it is not. So for that we use a real value. Simple growth rate formula. This is used to know the change. The growth rate or percentage change of any variable x over a time is the value of x in the final period. We can calculate the growth rate by production of 2025 minus production of 2024 over production of 2024 times 100. This shows our simple growth rate formula. We can know this by calculating in this form. The final production minus the initial production over initial production times 100. This shows the growth rate or change of percentage change of any variable. Real-time to nominal formula. The nominal value of some economic variable, example GDP, is the price level times real value of that economic variable. Based on this, we can calculate real value. How? Real value is equal to nominal value over price level. By this, we can make it real because the effect of price or inflation is avoided or removed at this time. The other, real GDP per workers. Real GDP per worker is equal to real GDP over number of workers. It is one of the best available measure of long-term economic growth. Example, nominal GDP of the United States in 2008 was 20.5 billion according to USA Department of Commerce. In the mid-year of 2080, population was estimated about 327,436,000. The per capita nominal GDP was 62,853. This is per capita income or GDP. If we know that GDP is the measures of everything that is produced, we should also ask the question, who buy all of this production? This is answered as in the following ways. This demand can be divided into four main parts. That is, GDP is equal to by consumer expenditure or consumption, who can buy this one, investment expenditure, government expenditure, and the net export expenditure, that is export minus import. Those are consumer expenditure or consumption, investment expenditure, government expenditure on goods and service, and the net export expenditure can answer this question. So this product is purchased by all of this one. This is how we can calculate our GDP by using of expenditure approach. The next one is, how can we calculate GDP by using different techniques? This is, let we see. Year 2015, 2016, 2017, the year given. Product 1 and the product 2. Let we calculate nominal GDP first. Under product 1, we have price of 15, quantity of 10 in 2015. Under product 2, price of 20, quantity of 50. In 2060, product 1, price is 100, quantity is 20. In product 2, price is 30, quantity is 100. In 2017, product 1 price is 150, quantity of the product is 20. Under product 2, price is 50 and the quantity is 200. Now let we calculate nominal GDP and the real GDP. First of all, to calculate a nominal GDP and the real GDP, we have to have base year price or constant year price, as we said before. But first of all, we know nominal GDP and the real GDP of the base year is the same. Note that the base year's nominal and the real GDP must be the same. Let we see. Nominal GDP of 2015 is 15 times for product 1, 15 is price, times quantity of 10 plus price is 20 times quantity of 50 under product 2. It become $1,500. This is our nominal GDP for 2050. Let us calculate again real GDP for 2015 or base year. Under real GDP also, the price is 50 and the quantity is 10 plus the price is $20 times quantity is 50, which is equal to 1,500. Because of this, nominal GDP and the real GDP of the base year is equal. I think this is very clear for my listener or my followers. Ladies and gentlemen, please, if you understand this one, let we come to calculate nominal GDP and the real GDP for the left years, that is 2016 and the 2017 years. For 2016, our nominal GDP is price of 100, we use 100 price, times 20 quantity for product 1 plus $30 of the price for product 2 times 100 of quantity 2. It become 5,000. What about for 2017 nominal GDP? We use 150 price for product 1 and product 1 quantity is 20 plus $50 price of product 2 times 200 quantity under product 2. It become 13,000. Let we see the change. What about for real GDP? We have said for base year, nominal GDP and the real GDP is the same because price is the same at that time, no change. So that's why it become 1,500 for 2015 real GDP, and also nominal GDP is $1,500. The changes on 2016 in the 2017, which is not base year. Let we see it. Real GDP by using of base years for 2016 is $15 price of the product 1 times 20 of quantity of product 1. Have you seen how it's changed? We have used price of 50, not price of 100 as that of nominal GDP. Rather, we use price of 2050 or constant price to calculate a real GDP. Plus $20 that we take from price of 2015 for product 2. We cannot use 13, rather we use 20 because we use base year price to calculate, but we use 2016 quantity we use is at that time or 2016, but price we take is from 2015 or base year. Then it becomes 3,000. That is 3,000. But when we calculate nominal GDP, we have our nominal GDP is 5,000. Currently under real GDP, that is 3,000. What is the difference? What is the change? The difference is around 2,000. From where do we get this 2,000? Why real GDP is 3,000 and nominal GDP is 5,000? the quantity is not changed. The quintal is not changed. The quintal for 2060 for product 1 is 20 quintal. For product 2 is 100 quintal. So, why it is changed? It is changed because of price change. Because of price change. Price is changed comparing with 2050. In 2050, price is 15. In 2060, price is 100 for product 1. In 2050, price is 20. In 2016, price is 30 for product 2. Because of this, the value of nominal GDP and the real GDP is different. So to show our real output or real quintal of our product or real quintal of our maize, we have to use a real GDP like this one. Like this one. Let me come to the next. In 2017, real GDP's price is the same as we said for 2016. That is price of 50 that come from 2015 or constant price times quantity is 20 plus price is 20 times quantity is 200. It become 5,000. What about the value of nominal GDP under 2070? That is 13,000. Around what difference? There is around 8,000 difference. The difference is because of price change, not because of values and volume, not because of volume, not because of productivity, not because of quintal of maize or quintal of other production, not because of production increase. It is only because of increasing in price that the nominal GDP is overstated like this one. So for one country, which one is good to show the economic growth of a country? That is, as you know, a real GDP shows actual productivity, actual increasement of the quantity of a country. That is why many countries use real GDP to show their real productivity. Have you cleared, students or my listeners, ladies and gentlemen, professionals, and so on? Thank you. Let's go for the next. The next is how we can calculate growth rates. We have said before, growth rate is calculated by the final products minus the initial product over initial product times 100. Then we see percentage change of the economy or percentage change of our GDP. Then let me calculate for 2015. We cannot calculate growth rate because we have no the initial value. Rather, we have only the 2015. For the next, for 2016, we can calculate growth rates because we have nominal GDP that is 5,000 for 2016. Also, we have nominal GDP 2015. So 5,000, that is 2016 nominal GDP minus 2015 nominal GDP over 2015 nominal GDP times 100 resulted in growth rate or changes. It shows change, percentage changes. What about 2017? We can calculate by using the same style. That is 13,000 of nominal GDP of 2017 minus 5,000 nominal GDP of 2016 over 5,000 nominal GDP of 2016 times 100. The percentage change or growth rate is 116. This is how we can calculate percentage change or growth rate of any product or any values. We can calculate by using of this one. This is a way of calculating the percentage change or growth rates. By what percent it is changed or grows. What about for real GDP? It is with the same style. Like we go for real GDP. Real GDP, as we said, nominal GDP in the real GDP for base year is the same. That's 1,500 for 2015. So with the same style, we cannot calculate growth rate of 2015 because we have no the initial one. So for 2016, we can calculate the difference between 2016 and 2015 of real GDP. So 3,000 real GDP of 2016 minus 1,500 real GDP of 2015 over 1,500 real GDP of 2015 times 100, that is 100% or 100. For 2017 with the same style, 5,000 minus 3,000 over 3,000 times 100, that is 67. This is how can we calculate the growth rates. The aim is to calculate growth rates. We go for the next. What can we calculate in the next? Let we see. Then calculating of GDP deflator or removing of the purpose is for removing of the inflation for specified base year. Then GDP deflators of y is equal to nominal GDP over real GDP times 100. By this, we can remove the price effect. For more understanding, look at the following example. Let we see. And with the same products, product 1 and the product 2, with the same price and the same quantity, let we calculate our GDP deflator as we said. GDP deflator is calculated GDP nominal GDP over real GDP times 100 as we said. Let we calculate GDP deflator for 2015, nominal GDP deflator, that is 1,500 over, that is over 1,500. Why? Because nominal GDP and the real GDP of base year is the same, that is 100% GDP deflator. For 2016, GDP deflator for nominal GDP is 5,000 over, that is 5,000 of 2016 nominal GDP over real GDP for 2016 is 3,000 times 100 is equal to 167. For 2017 nominal GDP deflator, that is 1,500 nominal GDP of 2017 over 5,000 GDP real GDP for 2017 times 100 equal to 216. Have you seen how we can calculate GDP deflator? First of all, we have to calculate our nominal GDP and the real GDP to calculate GDP deflator. That's why we go through this step. What is the next? There we go. The GDP deflator, that means removal of inflation effects and the inflation rates. GDP deflator is a measure of overall level of the price of the final goods and the service produced within a country during a given period of time. This is GDP deflator. That's why GDP deflator is used to understand overall price change. And it is growth rate is therefore a measure of rate of inflation which is given by growth rates equal to new value, final minus old value, that is initial, as we said before. Growth rate of any value or product is calculated the final minus the initial over initial times 100. See the following example to understand how it can be calculated. With the same year, the same product 2 and the product 1, and also the same quantity, the same price, how can we calculate GDP deflator and inflation rate? We have calculated before GDP deflator. That is, GDP deflator for nominal GDP is 100. GDP deflator for 2060 is 167, as we calculated before. GDP deflator for 2070 is 216, as we calculate before. And then also GDP deflator for the previous is as like this one. And now, how can we calculate inflation rate? Inflation rate is calculated by as we said, let we see that is GDP deflators, that is a measure of overall level of price of the final goods and the service produced with the country, we said. Now, let we calculate the inflation rate or growth rate, therefore the measure of the rate of inflation, which is given by change of the actual minus the old one, or that is final minus initial over initial times 100. Then inflation rate of 2016, 167 minus 100 over 100 times 100 is equal to 67. This is inflation rate. We calculate by using of GDP deflator of 2050, 2016, the 2070, for 2016, the 2070. For 2070 again, GDP deflator of 2060, 2070 minus GDP deflator of 167 over 167 times 100, that is 55.69. This is inflation. This is the change of price, or price change, or growth rate of the price, as we said, that is used for measuring of rate of inflation. What is next? Let we see. The next is how we can calculate growth rates. We have said before, growth rate is calculated by the final products or minus the initial product over initial product times 100. Then we see percentage change of the economy, or percentage change of our GDP. Then let me calculate for 2015. We cannot calculate growth rate because we have no the initial value. Rather, we have only the 2015. For the next, for 2016, we can calculate growth rates because we have nominal GDP, that is 5,000 for 2016. Also, we have nominal GDP 2015. So 5,000, that is 2016 nominal GDP minus 2015 nominal GDP over 2015 nominal GDP times 100 resulted in growth rate, or changes. It shows change, percentage changes. What about 2017? We can calculate by using the same style. That is 13,000 of nominal GDP of 2017 minus 5,000 nominal GDP of 2016 over 5,000 nominal GDP of 2016 times 100. The percentage change or growth rate is 116. This is how we can calculate percentage change or growth rate of any product or any values. We can calculate by using of this one. This is a way of calculating the percentage change or growth rates, by what percent it is changed or grows. What about for real GDP? It is with the same style. Like we go for real GDP. Real GDP, as we said, nominal GDP in the real GDP for base year is the same. That's 1,500 for 2015. So with the same style, we can now calculate growth rate of 2015 because we have no the initial one. So for 2016, we can calculate the difference between 2016 and 2015. The GDP deflator tells us how the overall levels of price in particular year compare to the overall levels of price in the base year. We can compare with the base year. Suppose the nominal GDP in 2016 of USA, 2018 of USA was $20,580.2 billion, and the real GDP of in 2018 with the base year of 2012 was dollar of 18,638.2 billion. Therefore, the GDP deflator for 2018 with base year 2012 was 20,580.2 billion over 118,638.2 times 100 is equal to, that is 110.42%. The GDP deflator for 2018 compared to the base year 2012 was 110.42. That means for the domestically produced final goods and service, price in 2018 were on average 10%, 10.42% higher than in 2012 or base year, because it is changed or price is very increased at that time in 2018. In this way, the overall levels of price for various year can be compared by comparing each year's price to the base year. By comparing of the base year, we can identify whether price is changed or not, and also we know our real value or productivities by using of this technique. I thank you, and please share comments and subscribe. Okay, you can also send me information if you need balayele@yeo.com. I thank you very much for your listening, for your view, and also for your comments. Please comment critically, comment to me. I need it to adjust myself, or I can add more than this. If you need detailed explanation, for example, in the side of policy, and also in different ways, I can explain. I can share for you what I know. Thank you once again. Thank you.